I'm here in San Antonio for REITs REITwise, our 2019 Law, Accounting, and Finance Conference. Joining me today is Mark Streeter, Managing Director and Head of REIT Credit Research with JPMorgan Chase. Mark, thanks so much for joining us.
Thanks, Matt.
Now, here at REITwise, you were on a panel focused on the state of the capital markets. Can you start by summarizing how the capital markets for REITs look today versus a year ago, and what your expectations are as we go through 2019?
Yeah, I think the capital markets are in pretty good shape. Last year, we saw a decent amount of issuance. This year, we think issuance will actually increase a little bit from a bond perspective. Ratings continue to march higher ever so slowly at this point in the cycle, but when we think about the capital markets and access for the REITs, it's pretty wide open at this point.
And there's always a lot of discussion surrounding leverage. What is your advice to REITs as they look to find that right balance?
I think it's interesting because there's been a lot of studies out there, a lot of the Green Street reports and so forth, showing the correlation between low leverage and stock performance. I do think, though, there's a little bit of a shot that management teams might overshoot on leverage in terms of getting it too low. I think fundamentally, commercial real estate and institutional quality commercial real estate, really that top quartile that the REITs own, those assets are inherently leverageable. And I think if you look at just efficient capital markets strategy for these REITs and so forth, that targeting leverage at 10 or 20%, I think that's too low. I think the sweet spot for leverage is sort of in that 20 to sort of 35% range. If you just look at asset volatility, even if assets fall sort of 50%, if you're only 35% leverage, then in that downturn, leverage might move to, say, 70%. But that's still a pretty conservative number in the grand scheme of things, given the liquidity that's in the secured market, which is really the backstop for leverage, especially when we're talking about the rated REITs.
Now, lastly, there's always evolution in the industry, and we've seen a lot of change. If I was going to ask you or if we were going to sit down 10 years from now, how different would the REIT market look?
I think a couple of things. So first off, what we've seen over the last 10 years is that the average rating, for example, for the large institutional quality REITs that are issuing unsecured bonds, that's moved up from BBB minus to BBB flat to BBB plus. I think that continues to march higher. I think we're going to see more A-rated REITs, in part because the rating agencies over time are going to realize that these very well-diversified large REITs, as they grow bigger, and that's the other thing that's going to happen over the next 10 years, we're going to see larger and larger companies as the market continues to consolidate. And these larger cap REITs that are operating with that, say, 20 to 35% leverage on however you want to measure it, that's really going to justify more A ratings.
Great. Mark, thank you so much for joining us.
No problem, Matt. Appreciate it.
For more information on this and other REIT news and analysis, be sure to visit NAREIT's website, REIT.com.